Two versions of the same city can exist at once. From a highway overpass, you see tower cranes, fresh concrete, and glass catching afternoon light. From a kitchen table 3 miles away, someone opens a renewal notice and finds the monthly number has climbed again. Both scenes are real. Both can be true in the same week. Local news may celebrate rising housing starts while neighbors swap stories about smaller apartments and longer searches. So why does the visible building boom feel disconnected from the squeeze at the lease signing table? And what would have to change for those two realities to meet? Most public conversation treats housing like a simple balance. Not enough homes, build more homes, problem solved. That story sounds clean because it matches how other products work. When shelves empty, factories ramp output and prices ease within a season. Housing refuses that timetable. A shortage is felt in monthly payments long before a shovel breaks ground, and relief is measured in years, not quarters. The people priced out today are rarely waiting on the units going vertical downtown this season. They are negotiating against the homes already standing, the walk-ups, duplexes, and older mid-rises that reprice the moment competition returns. The pattern shows up whenever credit loosens after a tight period. Households that postponed moves suddenly compete for the same limited stock. Prices and rents rise fast because existing units reprice immediately. Walls and plumbing do not multiply overnight. Only then do developers commit to long projects financed across multiple economic moods, betting that demand will still be there when the doors open. By the time those buildings deliver, the urgent crowd may have already doubled up, moved farther out, or locked leases at elevated levels. The new keys arrive labeled as supply relief, but they often serve yesterday's crisis while today's pressure has moved to a different tier of the market. Housing supply moves through stacked delays. Land has to be entitled. Financing has to clear at the bank counter before steel ever rises. Materials and labor have to align on the same calendar. Each step adds months, and any one bottleneck can stall hundreds of units that already look inevitable from a distance. Demand, meanwhile, responds to interest rates, job growth, and migration almost immediately. That mismatch is the engine behind recurring squeezes. Prices signal pain now. Construction answers a signal that was loud 2 years ago. Even when approvals accelerate, what gets built follows where margins are easiest. Larger units, amenity-heavy rentals, conversion projects, not necessarily the modest stock that absorbed the first wave of strain. Local constraints tighten the lag further. Infrastructure capacity, parking rules, height limits, and inspection backlogs can slow units that already counted on paper. A pipeline full of approved projects still dribbles into occupancy one certificate at a time. Meanwhile, existing landlords reprice off scarcity in the lived inventory, not the planned inventory. Empty units in new towers can coexist with zero vacancies in older walk-ups because those are different products serving different budgets. Headline counts of permitted homes understate how many are actually keys someone could use this year. The squeeze lives in the gap between permission and possession, and between possession and affordability. There is a trade-off policymakers rarely say out loud. Speeding approvals can expand future supply, but it can also attract capital toward segments that recover investment fastest, not segments where overcrowding is worst. More building can lower prices at the top of the market, while middle-tier rents stay sticky, because turnover slows when moving looks expensive, and every lease renewal becomes a defensive choice. Construction itself raises local costs. Workers need places to live, materials compete with other projects, so the cure can briefly intensify pressure in neighborhoods already full. That does not mean building is pointless. It means timing and composition matter as much as volume when judging whether relief is on the way. Imagine a renter in an older mid-rise whose lease expires in autumn. Across town, a new complex advertises move-ins for next spring. The renter cannot wait on that calendar. School schedules, commute routes, and deposit savings anchor them in the present market. Competing bids on similar older units push the renewal higher because every nearby alternative looks occupied. The new building eventually opens with concessions for early tenants, but its base rents sit above the renter's range, and its units are sized for a different household budget. The city reports rising housing starts, yet the household experience is a narrower set of choices and a longer commute if they leave. The squeeze loosens somewhere in the aggregate data while tightening in their kitchen. The repeating cycle is not mysterious once you separate announcement from occupancy, and occupancy from affordability at your tier. Shortages propagate through renewals first, construction second, and filtering across price bands last, if it arrives at all. Relief shows up unevenly. Concessions in one segment, silence in another, vacancy only where rent's already cleared a high bar. Watching cranes alone misreads the system because cranes measure intent, not access. The earlier signal is turnover in the stock people actually use, how long units sit empty at renewal, whether landlords drop asking rents on existing leases, and whether households stop paying premium prices simply to avoid moving during a tight year. So the city with cranes and the kitchen with a higher renewal are not contradictions. They are two timestamps in the same cycle, separated by entitlement, financing, construction, and marketing calendars that rarely align with lease dates on older buildings. Building more is necessary, but it arrives on a lag in slices, and often above the pressure point that hurt first. Until existing inventory loosens where you live, the squeeze can persist even while the skyline changes. Next time you hear that housing supply is rising, ask which doors open this year, and for whom, before assuming your corner of the market exhales.